You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors. Hey, thanks for tuning into this week's episode of the Tax Smart REI podcast. Today, we're joined with Nathan Cook, and we're going to be discussing how to use equity losses to offset real estate capital gains with something called active indexing. If you do have a stock portfolio, you're going to want to stay tuned. We're going to jump into all of that in just 1 minute. Most landlords are closer to achieving their financial goals than they realize. They are just a few moves away from meeting their cash flow goals and finally achieving financial freedom. Introducing Property Llama, the game-changing tool designed to help you unlock hidden opportunities in your real estate investments using the equity you've already built up in your portfolio. Property Llama is an online investment platform built by real estate investors for real estate investors, and their user-friendly dashboard gives you a crystal clear picture of your entire portfolio, and their team of real estate experts is there to help you plan the moves you need to make to hit your goals faster. With Property Llama, you can track and benchmark your investment's performance, model what-if scenarios to make smarter decisions, and work with their team of real estate investment professionals to discover new investment opportunities and accelerate your portfolio. When you sign up at propertyllama.com/taxsmart, you receive a free personalized one-on-one portfolio review with one of their real estate investment experts. Again, visit www.propertyllama.com/taxsmart to get started today. That's it for now. We'll dive right into today's episode. All right, and we're back. Nathan, thank you so much for joining us today. Would you be able to give our listeners a brief overview of your background and how you got kind of started in the space?
Absolutely. First off, thanks for having me, Thomas. So my background started in 2007 when I was 8 years old, investing in the stock market. I became in love with investing in economic research since then. It's been a journey of learning and improving every day. It's a pretty humbling space to work in. I've been blessed with the opportunity to work with mentorships and work with some Wall Street pioneers and also some very successful independent traders, just working side by side with them. I joined Raymond James as a financial advisor in 2024 at the start this January, and really just with the goal to push what the profession means for people.
That's awesome. I'm always intrigued by stock trading. It's something I've not have too much experience with, but I know some of our listeners definitely are in that space. But what we're going to be talking today is something very interesting. It can help a lot of investors out. So just a quick refresher for the audience. If you're out there, you're investing in rental real estate, you can use capital losses from stocks, ETFs, and other securities to offset the capital gains from selling your investment in real estate. That's what we're going to be honing in on today. So, Nathan, would you be able to kind of just give us a little bit of an overview of what this is? The foundation of this is tax loss harvesting, if I'm not mistaken.
Yep, absolutely. So tax loss harvesting in its simplistic form is just the action of realizing a loss in an investment. So closing out of the transaction is kind of the best way to look at it, saying I'm walking away from this investment, I'm taking the loss. And then the harvesting part is reinvesting the funds. So if you took a loss on investment, real estate, or a stock, and then you took the remaining funds after that sale and reinvested into something. Now you realize the loss, and when it comes for investing in the stock market, there's so many opportunities with good companies that when you realize a loss, I mean, think of a situation where there's competitors in the space. You could realize a loss in one competitor and move it to the other one. So you have that sector appreciation, but you might have had just a difference in the company and management. So it doesn't look like a like and kind exchange, but you still pick up that breadth of what the economy is doing. That's the simplistic form of just tax loss harvesting.
Got it. So within this strategy, it's called active indexing. Is it also sometimes go by indirect indexing as well?
Yes. Yeah, I've heard it as direct, active. It depends on the fund and who's the manager and what do they call it. So there's a lot of different ones, but yeah, active or direct.
Gotcha. So what exactly is active or direct indexing?
So direct indexing, think of the tax loss harvesting feature we just talked about. But when we look at just where the market's going and what it's done, you can look at an index like an S&P 500 or a Russell 2000 or the NASDAQ, which is a basket of equities. It's a performance of everything. You look at S&P 500, the top 500 stocks in the US. So you don't have just an investment in one company. You're diversified across 500 companies, and it goes on weight of market cap. Now, what we've been able to do with direct indexing and what other funds have been able to do is you invest in the 500 individual companies at the same weight of the S&P 500. So you're holding 500 different equities versus holding one investment in the S&P 500. So that's what direct indexing is. And the reason we do this is you hold 500 investments. If there's some losers and some gainers, you realize the losers and find a basket or an individual investment outside of the loser to replace it. So you have your winners, you have the efficient gain on your money. In the parts that you have your losses, you can realize them, move it within sector, and move it to something that's performed the same way. And then when the market recovers or that sector recovers specifically, you get the S&P 500 performance, but you've realized the loss on it, the losing part. It's kind of embracing the losses of the market or the downturns of the market instead of just having to ride out the wave. It's made S&P 500 investing and index investing more efficient. And it's been a strategy for a long time, but with technology, we'll talk about it a little bit more later. It's just been able to be scaled and it's cost effective.
Got it. So it's like kind of like when you're investing in, say, the S&P 500 and like an index fund or an ETF, you're investing in the entire basket through that vehicle. But here it's like you have an account and you're just buying what's in the S&P 500 or whatever the index is. And you're just mirroring it. But because you're not having it in, I guess, within the ETF vehicle, let's say it's like an ETF, you're not able to realize the losses when the ETF buys and sells these securities, but you are when you're doing the direct indexing.
Yeah, exactly. So it's what the ETF is doing on the behind the scenes, but you do it behind the scenes for yourself. So you look at the index, or you could be, if you wanted to be overweight in some ETFs or sectors, you could break it down to that as well. So you can have it with individual companies, but you also can tax loss harvest within ETFs. It just gets a little trickier when you have a fund manager versus a specific company.
That makes a lot of sense. So if we peel back some of the layers here, I have to imagine if you're going to be buying a piece of, say, every stock in an index, you have to have a substantial amount of capital on hand. Like, how much capital do you need to have in an account for direct indexing to make sense?
Yep. So there's different direct indexing strategies, but the one I'm specifically talking about is an equity, like an all equity direct indexing. And I've seen anywhere from about 100,000 to 250,000 as the starting with a fund manager. Now, some wealth management practices can do it like lower scale if they're going to onboard that responsibility in house. But the big thing with that is it could get very large quickly, but with fractional trading in shares now and just how we've been able to do that, and I would say the last 7 or 8 years, that's been a big adoption. It has reduced the cost. So it's important to put the fact in that you have the 100,000 to open, but once you have participating, you can put as little as $2 in. It's really the opening, and then you can trickle in funds.
Got it. So it's like you're not always necessarily buying one share of every piece. You're buying a piece of a share. Is that kind of what like fractional is? Okay. That makes sense. When it comes to like returns, I know what our audience is probably thinking right now. Like, let's just say I go out and I just keep using S&P 500 as an easy kind of index, just because I think that's how a lot of people think, right? If you were to say just invest in the ETF of the S&P 500 versus doing direct indexing, like how do the actual returns between the two differ, or do they differ at all?
There's little difference in the actual performance of the index and when you have the strategy. The tracking area is very small, and most times your goal is to get close to 100%. What we're seeing is 99% with providers, and it's just a little bit variable. It depends on which fund you go into or strategy exactly you go into. But the S&P 500 total return has been 10.5% if you reinvested your dividends since 1971. And people have been doing this strategy for a long time and been able to pull it to about 99% of the same performance. Yeah. So
it's pretty comparable, it sounds like.
Yeah, it's really become easier with the fractional shares. And that's been the real takeoff of why people have been able to adopt this. Before, it was millions of dollars in notional value.
Hey, are you tired of working with generalist CPAs that tell you can't use the real estate professional status, the short-term rental loophole, or cost segregation studies, or worse, have no idea what these things are? If so, it's time to elevate your game and work with a CPA firm that gets it. Here at Hall CPA, we worked with thousands of investors, helping them save millions of dollars in taxes through proactive tax strategy and planning, tax preparation, and outsourced accounting solutions. So if you're ready to elevate your game, make tax filing painless, and save thousands of dollars in taxes, what are you waiting for? Just head on over to www.therealestatecpa.com/podcast to request an initial consultation today. We are accepting clients for the 2023 and 2024 tax years, so if you're looking to make a change, you have nothing to lose. Again, you can request an initial consultation by visiting www.therealestatecpa.com/podcast. We look forward to hearing from you and learning more about your situation and how we can help. But for now, we'll dive right back into today's episode. That makes sense. Now, I know with ETFs, there's a lot of like low cost ETFs out there, which have like very small management fees that are associated with this. How does the cost of executing a strategy like this compare to, say, just investing directly in the ETF?
Yep. So it is more expensive than just the ETF, but with the technology, it's gotten significantly cheaper. And most of these strategies are done through a financial advisor or a practice. So when it comes down to cost, it's really, you should have a conversation, and ultimately always comes down to talking with your advisor to see what this cost will be and how does that fit into your total picture. Is it something, okay, we're going to offload in responsibility and we're going to take that cost off you, your cost hasn't changed? Or is it a situation where we think this added value should just be exactly what it's going to cost you? So every situation is unique. It's about talking to your advisor and seeing, okay, how does this fit into the picture? How much of the work is going to be done in-house or out-of-house? And the costs, they're significantly lower than they were, and they just continue to get reduced. So the S&P 500 you can get for about 0.01 of a basis point, so 100th of a basis point. I've seen anywhere from that to 35 basis points, so 35% of a percent.
It's not too much of a jump. It's a little bit, but not too far.
No, not drastically. Everything's about cost these days. So
Right, absolutely. And then with the risks, you may have already kind of answered this, but like, are there any specific risks that investors who might be considering something like this need to be aware of?
Yeah, I think timeline risk is, in our opinion, one of the biggest risks. Same with the S&P 500. You're going to be having the performance of the index. So when you have to access that money in a downturn, when it's not fitting your plan, your unique plan, what this is the goal of, for liquidity reasons or capital reasons, then it can get a little inefficient. It's always liquid, just as liquid as the S&P 500 or those stocks are. But within the structure and what you're paying for the strategy to do, pulling out when there is downturns obviously ruins the chance of you reappreciation. So that timeline risk is the biggest. And then all systematic risks you have with investments and the stock market is still present.
Got it. That makes sense. Now, I'm just like kind of thinking in my head, like all this trading back and forth, and you have some losses, you're going to probably have some gains, right? And naturally, capital gains get offset by capital losses. Is there situations where the capital gains that are like kind of generated through the strategy are completely offset by the capital losses that are generated to the point where they net to like virtually zero, and there's very little losses, excess losses, I guess you would say, that are left to offset, say, an investment property or something like that?
Yep, absolutely. I think the best way to look at it is the strategy, you're still getting that appreciation in value. And with the stock market has historically went up. So you're going to have an underlying unrealized gain if the S&P 500 or the NASDAQ or the Russell goes up. Now, I think the best way to look at it is it's a more efficient dollar when new investment. People are always worried about timing the market. And this really says, okay, regardless of when you buy, if you hold for the long term, you'll get market performance and we'll embrace those downturns. So you have a basket of losses over time generated with 500 companies. Some are going to do bad, some are going to do good. You realize the bad ones, you can replace them after you tax loss harvest within a period of time. You have to wait for tax purposes, but you get this basket. And then it's just a flexible, I would say, an asset. You have losses that are carried indefinitely forward until you have an offsetting gain. And then you realize them in the stock market if you want to keep your real estate, or you have one project and you realize them in that fashion just to limit those capital gains. But it just gives you that flexibility. And what I see a lot of people doing in the real estate space is you have a full project and it's been 20 years of developing and you've been managing this real estate and you've done well on it. And why not find another way to potentially bridge it out if you wanted to exit that investment? It's really good for people that don't have a lot of liquid options for capital to get that diversification. So yeah, you could realize more gains or you wanted to limit your risk profile within the stock market. You could use it the same way that, or you could diversify out of something outside of the market that you could use these capital losses for. So I wouldn't say it's a risk, but it is matter of fact that a gain loss, you realize it doesn't matter where you do it. If you want to access that capital, you're most likely going to have to pay gains. It's an investment. So it just gives you the flexibility.
Right. So it's kind of a few questions. I know we're going to get into some of the technology and who should consider a strategy like this and some other things. But when it comes to the wash sale rules, I know like if you buy stock, if you sell a stock today, you buy it back within 30 days or a substantially similar stock, right? You cannot take that loss. So how often does that become a factor in the strategy? Because I know like, I guess what the real question I'm asking is like, does there ever become times where like, from an investment perspective, it makes sense to buy that stock back within that 30-day window, perhaps, right? And then you're not realizing that loss. How often does that come into play here? Is that really like a non-issue at the end of the day?
It's a non-issue. It'd be an issue if people are doing wash sales within these strategies. The criteria with the software or just the criteria of managing it yourself, doing this, you want to avoid those wash sales because you ruin the tax benefit. So you have that 31-day period before and then the 30-day after, that 61-day period. So the goal is to find something that replaces the asset you sold and it correlates as closely as possible. There are circumstances, there's technologies and companies right now that are volatile and they could be presenting real change in our economy. That really comes down to the manager deciding, is it going to sacrifice the S&P 500, for example, performance if we get rid of this stock, and then balancing the risks of, okay, is the tax loss harvest worth it? Because we're still trying to get that performance of the S&P 500. So it shouldn't come into play. There's inefficiencies if you find something that in the past has performed the same way, but over time, you should work that out and get it close to that 99%.
Absolutely. And I'm glad to hear that because like we have a saying here, don't let the tax tail wag the dog. I know there's some people out there who might be listening to this and say, oh, if I sell this stock, I'll be able to take the loss on it. But if it's a bad investment decision, sometimes you may not want to do that. But it sounds like, for this particular strategy, it's less of concern for people who are using it. But I'm just thinking through like imagining this, like if you had to manage this yourself, right, as an individual, it's got to be pretty complex. So like, I guess what kind of tools and technology goes into like making this go and optimizing this?
Yeah, the tools and technology has grown a lot. The fractional shares kind of worry about the scale thing, get rid of that issue. But we can pull all data every day from something trading and snap of a finger within seconds, find something now with the proper tools and research that, okay, these things are going to perform in a similar way. I mean, they're all invested in with passive indexing becoming a pretty popular thing in the last 30 years with the S&P 500, the NASDAQ, those ETFs coming into play. You kind of get that same performance. But the big thing is technology over time saying, okay, this is when this period of the stock market, you can do this tax loss harvest. It's not as simple as saying, okay, loser, sell it. There's a lot of criteria, hundreds and thousands of data points and factors and say, okay, is the market volatile right now? Should we be considering that? Are the ups and down swings super aggressive? The potential for something to reappreciate value in the next 31 days? Is that a bigger risk? So technology has really grown. It's efficient right now. And being able to find a replacement within seconds really helps the scale and cost. It's a matter of research and time and having the fund manager, right criteria set to truly get the best performance.
Is someone actively making these trades or are these trades being done by an automated system? Like once this is triggered, then the system automatically triggers the sale.
Yep. So there's this strategy can be done in-house, but outside third-party providers, you're going to get probably most likely it's software with criteria set and a financial advisor knowing the situation of the client. you can tweak those criteria when you set up the strategy, and you can continue to tweak them. But if you go with a third party, most likely you're going to have an automated, okay, hits this criteria for the client and the advisor, and then it also hits our funds criteria. So yeah, it most likely automated, but I do know of people doing this strategy in-house.
Yeah, I can't imagine doing this in house. I mean, it's got to be a lot of work, man, to do this. But so, like, who should consider doing this strategy or using this versus, like, say, who should not consider using this?
Yeah, I think the who should not's a little bit easier when you are in a situation where you have most of your assets in a tax sheltered investment account like an IRA, 401k, or a Roth. There's no benefit to realizing losses because those losses are sheltered, which ruins the strategy. So most likely you want to use this in new capital deployed in a standard brokerage account, a taxable account. And then in terms of people, typically, the most suitable investors for the strategy are real estate investors and business owners that over time are continuing to appreciate their value in a liquid asset like property or a business. So if you can plan this, you're already most likely diversifying through the market just to get different places for retirement baskets. But most likely you're going to have a suitable with a real estate investor and a business owner. Because then it comes down to the day, it's like, okay, there's less variables with these losses being realized than realizing something like a business. So that's the real benefit. And then there's a lot of planning benefits of this with business owners potentially selling the business or passing it down. Same with real estate. Okay, this is my retirement plan is getting out of this business. And okay, I have these losses now generated. Might be a negotiation or a flexible part of a conversation for buying and selling with someone as well, saying I can get a true cost on this better because I have these losses over time.
That makes a lot of sense. In regards to the real estate side of things, like we have a lot of listeners of this show. Some of them are real estate purists. They only have stuff in real estate. Some of them have a portfolio and they have it diversified. All this, like, it's a mixed bag of people who listen to the show. For the people who are maybe real estate purists, I'm of the belief that I'm not a real estate purist. I believe you should have some assets in the stock market or in ETFs or whatever the case is for many reasons. Like, what do you say to those people who believe that they should only have real estate or only invest in real estate? What do you say to those people about investing in the stock market?
Yeah, I'm a true return guy, and I think there's a lot more flexibility in planning. Just where does your dollar go and what is it getting you? And then how much of your time is it taking? I know real estate, a lot of the time you can be an LP or you can be an outside party just funding, but you own the real estate. But a lot of the time I see a lot of people owning real estate, fixing up the properties, doing it all themselves. Just the aspect of passive versus active in terms of where your investment dollars are going. I think planning ahead, as long as you get good return and you know what those returns can be mapped out in, it should be considered, the stock market should be considered for a different basket of liquidity needs. Because we don't work our whole life. At some point, you're not going to want to be as active. And real estate sometimes doesn't offer that opportunity. When you own a company via stock, they're working every day for you, is the best way I like to look at it. So that way I come encounter with a lot of real estate purists as well. And it's went so well. But at the end of the road, if you're not prepared, and you guys do a great job of educating and preparing real estate and purists, the tax consequences when you want to get out, just finding a more flexible bridge to get out and have that money to live on. The stock market is a good place to do that.
Absolutely. And the way I kind of think of this too, I agree with everything you just said there. And the kind of way I think about this is like when you're an active real estate investor, or even when you're a passive real estate investor as an LP, there's human error, the risk of operational risk, I guess it would be at the end of the day. I've seen investors, do everything right, and people maybe get cleared out in the 2008 crash, or people maybe just make a series of missteps or bad decisions, or they over leverage their portfolio, and an empire could fall, right? And the way I kind of look at the stock market is like you have other people doing this on your behalf, right? Like, if you invest in yeah, I'm just gonna, again, the S&P 500, like as long as you have the fortitude not to like panic during periods of volatility, like in the long run, it's harder, in my opinion, it's harder to lose money in the stock market, again, in the long run than it is in the real estate world, especially if like, you just make a few mistakes. So like the way I kind of look at stocks, almost like from the perspective of a real estate purist, like if I were to put myself in their shoes, like if you make it, like I said, if you make a few bad decisions, you could destroy your entire empire. But if you just have some of your portfolio in the stock market, those decisions are being made by somebody else, and you're kind of insulating your risk, or you're kind of diversifying your risk. I don't know if that makes sense, but that's kind of my thesis for not being all in on real estate. So I don't know if that helps anybody out there, but hope that helps a little bit. When it comes to like, do you have like any case studies or examples, maybe, not asking for any names or anything like that, but like where real estate investors have used this strategy to reduce their tax liability?
Absolutely. I see it firsthand day to day without names or anything, just being a financial advisor. And that's kind of my niche market. What I've found is, okay, this strategy, this is a good way to get in with real estate purists. I've had conversations with real estate purists, and this has been the sole reason they get in the market. You could never convince them to own stocks. They've done so well in real estate. But when you pitch it as, okay, this is just a complement to your real estate. I'm not expecting you to get out of your real estate and get in the stock market. But if you trickle these funds in, or you take some income from one property and you want to get it in a capital gain situation that's more flexible, and then you put that tax loss harvesting benefit on the back end, it's been an amazing just opportunity to get through to them and talk to people that are real estate purists, that are in good situations, fantastic clients, hardworking people. When you talk about the taxes part of it, that's where it really gets through. Okay, this is why you need a part of the market. And then the diversification too. You've made a great point on that regard. So
Thank you. I know we covered a lot today, and obviously, I think this strategy makes a lot of sense. Like, is there any additional insights or practical tips you might have for the listeners who might be interested in exploring this strategy further?
I think the first thing to do is always just research on your own and see if the information we've said and what you find on the internet and wherever your sources to be is valid. You can research it. You can just go on Google and look up direct indexing is a great start. You're going to see some of the people I'm talking about, the funds. I haven't seen a strategy with direct indexing where you haven't been able to work with an advisor. It's just kind of the criteria, because there's some things you have to set up front that is in the investment profession space that you should talk with your financial advisor about. And then leading into that, you should talk with your current financial advisor, find a financial advisor. If this is a strategy that you'd like to implement or learn more about, going to a source that you know is unbiased and for your best benefit is always the best to learn after you get the general idea and see if you want to go forward with one.
No, absolutely. It makes a lot of sense. Always got to do your own due diligence, and of course, then speak to the professionals to make sure that it makes sense for you. Because I could see a lot of people out there, if you're listening to this, I know a lot of people who are active investors who do like to do things yourself, and I understand that. But I would say this is definitely something you'd want to get professional help with before trying to execute yourself. Just a warning out there. But if any of our listeners want to get in touch with you or learn more about what you have going on, how could they do that?
So the best way to get in contact with me is through my email or my social media. So my email is nathan.cook@raymondjames.com. And then I have a LinkedIn. If you look up Nathan Cook, you should be able to find me. And then also I have a Twitter page, Nathan C. Cook, that I just got active again, Nathan_C_Cook, where I'm really trying to provide just value to someone's day, ways to think about the market in different markets. So those are the best ways to get a hang of me. So.
All right, awesome. So we're going to go ahead. We're going to drop that all into the show notes for everybody who's listening. If you do want to learn more about the strategy, you do want to connect with Nathan, you can go ahead and follow him on social media. And, he has his email there as well. Nathan, it's been a pleasure to have you on today. I know I learned a lot about direct indexing today. And now it's yet another strategy, another exit strategy for real estate investors. I think we did an episode a few months back on 7 strategies for real estate investors, and we covered a bunch, 1031 exchanges, we covered a bunch of different things, but now there's just another one to add to the list. So thanks again for sharing that with us and joining us on the show today.
Of course. Thanks, Thomas.